So good afternoon, everyone, and welcome at our webinar in collaboration with Mazars about the tax and social security consequences of a home office context. This is a topic that is more actual than ever, of course, since we have started working from home much more during COVID. And so today we discussed with the professionals from Mazars who got this question quite often to do this webinar with you to inform you more about this. For those who do not know Mazars, I think most of you do know, but a few words about Mazars. They're a leading internationally integrated partnership. They're specialized in audits, in accountancy, in advisory, and in tax services. They are a worldwide firm with over 95 firms in 95 countries, and they have 47,000 professionals working for them worldwide. And 5 of these professionals are with us today. They're going to talk really about the global mobility services, like I said, really actual currently. So I really would like to thank the 5 speakers that we have. We have with us Elodie Cocheteux and Sofiane El Boujoufi, who are working for the French desks in the Netherlands. And on the other hand, we have Sylvie Collignon, Mike Hoffman, and Anna-Fie Suzanne of the Dutch desk in France with us as well. So we have a nice bicultural, binational couple of people with us. So I'm going to give the floor, first of all, to Sylvie Collignon to speak about Mazars as well.
Thank you, Sylvie. Hello, everybody. My name is Sylvie Collignon, and I head France for Global Mobility Services. I have more than 26 years of seniority, and I have my expertise working in Belgium, Switzerland, France, and the Netherlands and Sweden. Advising not only global mobility services, but personally living the change of tax residency between the home country and host country, living in Amsterdam and Göteborg. I would like to present what is really global mobility services, the offer of Mazars. So international mobility is a complex area for employer that cover all the legal issues related to sending of employee and family from a home country to a host country, assigning employees from a home country to a host country, but with keeping the family in the home country, or commuting from a home country to multiple host countries for one business day or more, and more recently with the remotely work imposed by the pandemic and adapt in our new way of working business. These legal issues can be found in the following matters: professional migration law, labor law, social security law, personal income tax law, and after all matters translate in international payroll. Today, we will discuss about the social security impact and personal income tax matters related to the professional relationship between a French tax resident working for a Dutch employer and a Dutch tax resident working for a French employer. So I let the floor to Sofiane.
Thank you, Sylvie. Good afternoon, everyone. My name is Sofiane El Boujoufi, working for Mazars since 2015 as a tax manager, member of the French desk, and specialized in global mobility services and employment taxes. So, occasionally working with Sylvie and Mike from the French team with various topics. Thank you. Mike?
Thank you. So my name is Mike Hoffman. I'm a French tax lawyer at Mazars. So I will start this webinar for us by giving some words about the introduction. So Sylvie already mentioned in the intro that we are looking at. Sorry guys, I have some echo. If you can close the microphone, mute. Thank you. Now, thank you. It helps. Thanks. So yeah, the starting point is a situation where we have an employer in one country, resident of one country, and the employee is a resident of another country. So it's very important to understand this, that we are looking at situations where the residency is not the same. Okay. So of course the concept of residence here would be key. And I remind you that for taxes and social security contributions, a person can only be a resident of one state. Yeah. So in case we have a conflict between two states, such conflict of residence must first be solved before we can correctly apply the taxes and the social contributions. As I said, we will not have the time today to go into very much detail of what is the residence concept, but usually a person is a resident of a state because it has very close ties to that state, such as his home, family, children going to school, friends, and work. Okay. So that is an important assumption for this presentation. So on the other hand, what are we not going to discuss? We're not going to discuss the situation of a Dutch employee with a Dutch employer. The Dutch employee bought maybe a secondary home in France, and he goes to France for a couple of weeks where he works remotely. That's what we're not going to talk about. Why are we not going to talk about this? Because it's, in our view, it's not critical. Okay, from a tax and social security perspective, it's not going to change significantly the position for income tax and social security contributions if you spend only a couple of weeks or maybe even a couple of months in another country. Okay, it's really getting an issue if you're spending more time or even becoming, as I said, a resident of that country. We will also not discuss the labor law consequences of such a cross-border situation. As you can imagine, there are many topics related to labor law, but we cannot cover this because it's just simply not enough time. Okay, so let's start with the first topic. Sofiane will talk about the impact on social security contributions of our cross-border scenarios.
Thank you, Mike. Well, social security is an important topic that affects many people's lives. In this presentation, we will provide an overview of the most important provisions of the EU regulation and how they impact individuals who are covered by this regulation. But first of all, what are social insurances? Social insurances provides income in the event of, for example, unemployment, retirement, disease, death, or incapacity for work. And it happens that people work in several EU countries at the same time. This is, for example, the case if you live in the Netherlands and work in a home office for a French company, or if you visit a French customers for them. But this may also be the case, for example, if you deliver to customers in several countries as a truck driver, for example. European law states that a person can only be covered by the social security legislation of one country. And the allocation rules relating to social security are based on EU regulation 883/2004, which may be known for some of you. And it is important to know whether you are a self-employed, an employee, or a civil servant. But in this session, we will only consider the rules relating to employees. The EU regulation prescribes as a main rule that persons are socially insured in the country of employment. And there are various exceptions to this main rule, including an employee who works in 2 or more EU countries, or an employee who is temporarily assigned. The first exception applies for an employee who works in 2 or more EU countries at the same time, so in the Netherlands and France. This employee will be insured in his home country if he works more than 25% of his time in his home country. And if the employee works less than 25% of his time in his home country, the country of insurance is the country where the employer is established, so the work country. Another exception applies for temporary assignments, and the assignee can remain subject to social security legislation of his home country and be exempted from the social security contributions of the country of employment. This exception applies for a period of maximum 2 years but may be extended up to a maximum of 5 years if the countries involved approve so. So anyone who regularly works in more than one country should apply for an A1 certificate. And this basically determines which social security law the person will be treated under. And as a rule, the application must be made in the home country. So in this session, we will mainly talk about working in 2 or more EU member states. So I will discuss 2 examples to clarify the allocation rules in more detail. Next slide, please, Mike. So in this first example, we have a Dutch employer with a French employee who works also from a home office in France. This employee will be insured in the home country, France, if she works more than 25% of her time in France. As a consequence, the Dutch employer deducts and pays French social security contributions on the entire salary. This also means that an employee registration in France is required. If the employee works less than 25% of her time in the home country, France, the employee will be insured in the Netherlands, the country where the employer is based. The Dutch employer will have to deduct and pay Dutch social security contributions on the entire salary. Next slide. So if we now look at the opposite situation, now we have a French employer with a Dutch employee who also works from a home office in the Netherlands. We apply the same rules in this example, and this employee will be insured in the home country, the Netherlands, if she works more than 25% of her time in the Netherlands. This will also mean that the French employer deducts and pays Dutch social security contributions on the entire salary. An employer registration in the Netherlands is also required in this situation. If the employee works less than 25% of her time in the home country, the Netherlands, the employee will be insured in France, the country where the employer is established. The French employer will, in that case, also deduct and pay French social security contributions on the entire salary. Next slide. So as a result of the COVID pandemic, a lot of employees have been working from home or remotely. And for employees living in a different country than where their employer is located, this meant that their work state may have changed compared to the situation before working remotely. In order to avoid negative consequences from working in a different country, the EU countries have introduced a period of flexibility for workers who carry out a substantial part of their activity by teleworking or home working in their state of residence. This basically means that a change in the working pattern in the period from 12 March 2020 up to 13 June 2023 does not have any consequences for the social security position if an employee temporarily works in another country, for example, as a result of working from home. However, it is important to keep in mind that if there is going to be no further extension, as from 1 July 23, the normal rules that I just explained before with respect to social security will apply again. So this means that the social security position of you as an employee or you as a company with possible registration obligation in other country, if an employee's social security position has shifted, may shift to France or the other way around, depending on the number of home working days in France. This could also result, among other things, in a change of net income after deduction of taxes and social security contributions, the continuation of a Dutch health insurance and its coverage, for example, the accumulation of old state pension, which is called in the Netherlands the AOW, and the participation in a Dutch pension scheme and the pension build-up in the Netherlands. So all these things may change in the situation if the social security position of an employee shifts to France, for instance. The social security authorities in the Netherlands explicitly stated that as far as they are concerned, this exception also applies to new cases. However, if the employer and the employee have agreed independently of COVID-19 to introduce telework measures on a permanent basis, this special agreement will not be applicable. This means that the basic rules that I just explained will apply. So please keep this in mind, that, well, this exception applies also for new cases. However, the contract with the employee does not have to have any article or that mentions that the employee is allowed to work 3 days a week from another country, for example. Next slide. So teleworking from home seems to be increasingly a part of everyday work practices for many people. The Social Security authorities understands that more flexibility is desired in the insurance determination of individuals teleworking across borders. So an amendment of the EU regulation is necessary. A number of proposed change that I can already share with you is that remote working will be defined in the EU regulation. There are three important conditions. One is that it must concern telework in another state than the state in which the employer has its seat. So we have a Dutch employer, but the employee is working from France, for example. The second condition is that it must be through an internet connection. So we are talking about a flexible employee who is able to use his or her internet from a home office, and not, for example, a truck driver that is driving in France for a Dutch employer. And thirdly, well, the location is not important, which basically means that it can be France, but it can also be another country, or within France from a home office, or from Starbucks, for example. So the location is not important in this case. And a second important change that they proposed in the EU regulation is that if 50% of the time is worked in the state of residence for an employer in the other state, the social security system of the work country, so where the employer is based, will continue to apply. So it seems like that the 25% threshold, which I just explained, will no longer be applicable for remote workers, but instead we are now looking at a threshold of 50% in case of remote working. So this basically means that an employee can work from home less than 2.5 days a week without social security consequences. But finally, I would like to note that this is not yet official, and it was obtained via confidential and off-the-record discussions. But I believe it is good to know that changes are coming, and especially with respect to remote working and the 25% threshold that is currently applicable in these situations. And next slide. So finally, I would like to discuss some formalities to keep in mind. In the first situation, where the French social security system is applicable, the following should be taken into account. First of all, an A1 certificate in France will have to be applied for and will be issued by the French Social Security Agency, URSSAF, and the S1 certificate by the French Public Health Insurance Body, the CPAM. And if the social security position of an employee has changed from the Dutch system to the French social security system, it is possible to remain insured in the Netherlands on a voluntary basis for the national insurance schemes, the AOW and the ANW, and for unemployment and incapacity for work, which is the VW, the VIA, and the Ziektewet in the Netherlands. But please note that there are certain conditions that have to be met before being able to apply for these exceptions. In the second situation, where the Dutch social security scheme is applicable, the following formalities should be taken into account, which is the delivery of an A1 certificate to the French Public Health Insurance Body, the CPAM, and an A1 certificate must be applied for with the SVB, not the Silicon Valley Bank, but the Sociale Verzekeringsbank, which is basically the social insurance authorities in the Netherlands, and an S1 certificate by Dutch health insurance. Well, thank you for your attention. That's it from my side. I don't know if there are any questions. I saw some questions coming in, or are we going to do the questions at the
If
end?
you're okay, I think it's good to do the questions because it's, if you're all, yeah? Do you want me to read them, Sofian? The question?
Oh, I see them myself as well. So the first question from Nicolas: does the employer registration require a legal entity? So from a Dutch perspective, it is not required to have a legal entity in the Netherlands. You can basically register the French company in the Netherlands as a French company. And maybe Mike or Sylvie can confirm for France.
Is the same position for France, but we will discuss in the last section about the qualification or not of the permanent establishment. But for sure, you can, the Dutch employer can be registered without establishment in France, so without legal entity.
Okay, thank you for your question, Nicolas. And the second question is from Soufiane, same name as I have. From your experience, is the 25% threshold considered on the week, month, or year? This is based on a 12-month period.
And I confirm the same position for France.
Okay. Well, thank you for your questions. So I will now hand over to Sylvie, who will discuss the income tax consequences for the employees. Thank you very much.
Thank you, Sofiane. So we will discuss about the personal income tax impact. So you just hear about the social security impact, and we will combine with the personal income taxation. So just to brief remember, even if it's not the topic of the webinar, but we would have the same example. So a French tax resident, which is also a Dutch non-resident taxpayer, and we have a Dutch tax resident, which is also a French non-resident taxpayer. And what is the consequences of the tax residency? The tax resident must disclose its worldwide income, while the non-resident taxpayer must only disclose their source income. So to come back to the example, so the French tax resident must disclose its worldwide income, so the French source income and the Dutch source income. And as a Dutch non-resident taxpayer, he must only disclose his Dutch source income in the Netherlands. So for the Dutch tax residents, he must disclose his worldwide income in the Netherlands. And as a French non-resident taxpayer, he must disclose his French source income in France. So that is the remember. So what is the principle of taxation? Well, it's like a social security, the same principle. You are taxed in the country where you perform your professional activity. So as for each principle, we have exception. And the exception is the short-term assignment principle. So you need to meet 3 cumulative conditions in order to remain with the taxation in the country of residence. So think about the situation where you are a French tax resident and for business purposes, you need to fly 1 day in Germany, 1 day in the Netherlands, 1 day in Switzerland. So with the main principle, you have an obligation of disclosure because you are taxed where you perform your professional activity. So in order to limit the tax burden, administrative burden, we keep the principle of taxation in the home country if you meet the 3 cumulative conditions. First one, you need to spend less than 183 days in the other countries. So that means 365 days divided by 2 plus 1 day, okay? So if you spend less than 183 days in Switzerland, let's say, you still be taxed in France. The second principle is that the remuneration should not be borne by an employer based in the country where you perform your professional activity. So I come back with my Switzerland, there are no employer, the employer is ever in the Netherlands or in France. That means that the remuneration is not borne by a Swiss employer, so no taxation by Switzerland, but still in the country of residence. And the last criteria is that the remuneration should not be borne by a permanent establishment of the employer in the country where you perform your professional activity. So in the case at hand, we have a French tax resident working for a Dutch employer, okay? So let's say that, coming back to the example, the French tax resident spent 5 days per week working in the Netherlands for the Dutch employer. So that means that the second condition is not met because the employer is based where you in the state where you perform your professional activity. So the taxation will go not to France, but in the Netherlands. So in the situation where he spend 5 days per week in the Netherlands, he's fully taxed in the Netherlands and social secure in the Netherlands. We can go to the example, Mike. So if coming back to the example of a fully work in the Netherlands, let's say now that the French tax resident spend 4 days per week in the Netherlands, physically working in the Netherlands, and only 1 day in France. So is still social secure by the Netherlands because less than 25% working in the home country and is taxed in the Netherlands for the 4 days as a non-resident taxpayer and only 1 day in France. And here is the new event as from January 1st, 2023. The tax collector for the 1 day performed in France will be the taxpayer, not the Dutch employer. Coming back to the example, let's say that the French tax resident spent 3 days in the Netherlands working for the Dutch employer and 2 days in France working from home. So in that situation, social security is switched to France and the Netherlands will be capable to tax 3 days in the Netherlands and France need to receive the wage tax for the 2 days performed in France. So here the employer, the Dutch employer, will have an obligation to get registered for social security and wage tax purposes with the French authorities. The same principle will apply if the French tax resident spent 2 days in the Netherlands and 3 days in France. So we will have the same example, but the different country combination. So next slide, please. So this is what I just explained. So here, you can go. Thank you, Mike. So now we are with a Dutch tax resident and with a French employer. The same combination, the Dutch tax resident commute on a weekly basis, working 5 days per week in France. So he will be social secure by France and he will pay fully tax in France as a non-resident. If we start to split the week pattern between work in France and work remotely from the Netherlands, if he spent 1 day working in the Netherlands, he will be taxed for 1 day in the Netherlands. So the French employer should get registered with the French administration only for loan purposes. If the Dutch tax resident spent 2 days in the Netherlands working remotely and 3 days in France, Social Security would change to the Netherlands. So the French employer should get registered for Social Security purposes and loan purposes in the Netherlands. And in France, the French employer should only be liable for wage tax only for the days he performed his professional activity in France. So that means that you need to track the physical presence of your employee. You need to know where your employee is working. And let's say that the Dutch tax resident for the French employer has an obligation to perform a business trip, let's say in Italy. That days performed in Italy will be taxed in the country of residence. Okay, so the Dutch tax resident will have a worldwide obligation of disclosing his worldwide income in the Netherlands. And in France, he has to disclose only the French source income, and the employer is the tax collector with the withholding tax on a quarterly basis to file to the French tax authorities. You can go a little bit. So this is also the formalities. So the Dutch tax resident should pay Dutch wages and Dutch social security. We need to have a recapitulative statement of the salary on a yearly basis, and he needs to file a Dutch tax return on his worldwide income. And in France, he is considered as a French non-resident taxpayer, and he pay on a monthly basis French withholding tax, but file on a quarterly basis. And he has to file a French tax resident only for disclosing his French source income if he reach the 12% tax bracket. So really important, one social security system, but different system of taxation. And to apply a correct tax treatment and to avoid double taxation, you need to ask your employee to fill in the travel calendar. It is crucial in international context of professional situation. Thank you, Mike.
All right. Thank you both. So now we are moving to another topic which is important in this cross-border employment situation, which is the taxation of the company, of the employer as such. And I'm talking about corporate income tax here. Okay. I know this is not a very common topic, but it happens more and more often nowadays that the country where the employee is actually working for this foreign employer, but this country says maybe there is some added value that is created here in France by this employee working from France, and I want to tax this. Okay, I want to tax the foreign employer, the foreign company in France. So that is what we call the permanent establishment problem. It is simply trying to identify whether we have an added value which is created in the country where the employee is a resident, can be France, can be the Netherlands. And if that added value is permanent, yeah, then we may have a permanent establishment. Okay. So that's a complex thing explained, I hope, simply, but let's go a little bit more into the detail. When do we have actually a permanent establishment? The permanent establishment is a place. It is a place, okay, a workplace, probably also home, where the business is carried on, Okay, so if I have an employee I am a Dutch employer. I have an employee working in France. Most likely his home, is this place where business of mine is carried out. Because the employee is part of the business, and he does this business from France. Okay. So today we can say, although from a French perspective, there has not been any clear guidance on that, but we as advisors, we believe that the home office can very well constitute a permanent establishment because it's a fixed place. And the employee, when he gets up in the morning, has his coffee, starts to work on his computer, he's working for the employer in the other country. Okay, so that's why we think that home office can very well be a permanent establishment. There's an alternative criterion for permanent establishment if you don't have a fixed place. In case you don't have a fixed place, or because the employee is traveling a lot, or maybe he's a sales representative, for example, and he's not working from home, but he goes to the client's premises. In this case, we have this alternative criteria of what we call a dependent agent. And what is a dependent agent? Is very simply an employee who has the authority to conclude contract in the name of his employer. Okay, so very typically a sales representative. You are a Dutch employer, you have a sales representative in France, he negotiates and concludes contracts, you have a permanent establishment in France, okay, for sure. In the past, what was always done is that when someone had a presence like in France, they said, well, we authorize him to negotiate contracts, to contact clients, do any time of work, but not sign. Okay, not sign, because signature is done back in the Netherlands, back at the head office. Okay, so the formal signature was actually done at the head office in the Netherlands, and this practice is now a little bit at an issue, because the French tax administration, the French courts, the Conseil d'État, which is the highest court of France, has ruled that we should look not only at where will the contract be formally signed, but we should look at the entire function, the entire role which is played by the French employee in France on the ground. Okay, what does he do? And if he creates this added value, if he's negotiating the contract systematically, he has the freedom to negotiate the terms of the contract. Then we say we have a permanent establishment, although the headquarter is signing it per se. Okay. Here are the consequences of this. Okay, if I consider that my employee is a permanent establishment of the employer, then the profit of this employer, which is subject to corporate income tax, must be shared between both countries. Yeah, we have a pie, and the pie must be shared. A little part of the pie should go to France if it's a French employee, or if it's the other way around, then a little part of the pie should go to the Netherlands. Yeah, of course, it's very complicated to identify what is the added value created. You have experts to identify this. This is economic studies, transfer pricing studies, etc., to find out how much value is actually created. Okay, so it's very important to understand that what is relevant is the presence of an employee in one country, and this employee is actually having a added value function, job. Yeah, because that is the thing, that is what will trigger the tax. Okay. As I said, the most difficult thing is to correctly allocate the profits according to a method which is recognized by both countries. Of course, what I don't tax in the Netherlands and I tax it in France, Netherlands is not going to be happy, and vice versa. Okay, and of course, what is also very important is to identify the PE. And especially if the PE is identified during a tax audit, because that is what happens, unfortunately, a lot nowadays, is that the employer was not aware at all that his employee working in the other country was constituting a permanent establishment. And then there is a tax audit. And then tax administration, of course, usually it starts very smoothly, yeah, very nice, just asking what is this person doing, and don't you think that you have to file a corporate income tax return. In this case, what you should do, of course, is you should at least get in touch with the tax administration. Okay, I think that is very important to establish the dialogue. Okay, do immediately, of course, an audit and see what is this person doing. Does it constitute a permanent establishment? As I said, there are big chances nowadays that you have a PE with a home office, for example. So almost every situation can constitute a permanent establishment. Of course, there are always exceptions, but many situations constitute a permanent establishment. Yeah. Also, why is it important to identify the PE? It's because the statutes of limitation, so the years that are open for an audit are usually longer if the permanent establishment is not spontaneously declared to the French tax administration. Also, tax administrations can evaluate the profits to allocate to a PE spontaneously, so they do it. Okay, if you don't do it spontaneously, they will do it for you, and that is not a comfortable situation. Okay, when the tax administration starts to evaluate your profits, that it's not a comfortable situation in case of an audit. Okay, and then of course, more seriously, it can also be an issue of tax fraud. Okay, for now in France, this is not yet an issue. But let's face it, things are changing. We have seen Panama Papers, etc., over the past years have significant consequences in the relationship between taxpayers and the tax authorities. So even if you claim you are in a good faith position, it can happen nowadays that it is considered as tax fraud because you are just having profits in a country which you didn't file. Okay. So here, the really best recommendation is do your permanent establishment analysis. Okay, assess your risk. Okay, if you want to disclose it, do the correct allocation, and then, of course, make sure the position you take is recognized in both countries. Voilà, that was it for the permanent establishment. The timing is actually perfect. We expected to have like 10 minutes for Q&A. So let's see, are there any additional questions? Maybe things we want us to repeat because we were a little bit quick.
Maybe good if people have a question that they just open their camera and video. So it's nice to have an interaction and to really be able to share directly. And take your chance, because I don't think it's often that you have four professionals from both France and the Netherlands in front of you. So who wants to ask a question? Well, if everyone is still shy, I have one. May I allow to ask a question then, Mike?
Yes, of course. Did you register?
I did register anyway, so it was about the permanent establishment.
Yeah.
I was wondering if I understand well, if I've understood well also in the past, is that if there is let's say a French company who has one Dutch or one employee in the Netherlands working from, well, home or from client sites in the Netherlands, is there still a difference if he signs the contracts or not, that employee? Whether
that is, it's actually more a question for a Dutch corporate income tax specialist. We have many people on the call today, but I don't think, Sofian, you know the exact answer to this, the formal versus non-formal.
Yeah, I can elaborate a bit about or explain a bit about. I'm not a corporate specialist, but if an employee is working in the Netherlands for a French-based company, and this employee is authorized to sign contracts and to act on behalf of the French company, he or she can be considered to be a permanent representative, which basically leads to a permanent establishment in the Netherlands. with all consequences Mike explained.
Yes, exactly. The question is now, Sylvie, is more if he has formally not the authority to sign, because that was a little bit the trick, you know. We mentioned in the contract, in the employment contract, that the person has no authority to sign, and that is why French case law, when it was the other situation, said, well, that is a little bit too easy. Yeah, I'm really looking at the complete function what the person is doing, and interestingly, the French-Dutch tax treaty, okay, could in a near future be modified in that sense, okay, because the tax treaties are all currently being modified, and this question, whether it is the formal authority to sign or any type of function you have that constitute a PE for the dependent agent, will definitely be addressed if the treaty is going to be changed, because in the new version, it definitely says we're looking at any type of functions which is performed by this person. But Sylvie, you know what is also important to notice, and I think here's where the Home Office kicks in. Even if you don't have the authority to sign, anything you do in a fixed place, you know, it's an alternative criteria. Yeah, criteria number one is a fixed place, and number two is that's alternative is the authority to sign contract. So even if you don't have the authority to sign contract, you still have a fixed place, and that is what we believe with the Home Office. Okay, the Home Office is this fixed place, so anything you can do actually could create a permanent establishment. So at the end of the day, it's most about valuation. How do you think that the work of this employee contributes to the overall profit of the company? Yeah. So and if you're a big firm and you only have one person in another country and is, you know, and is a small piece of a big thing, I don't believe the tax administration will go after this person, okay, or after the company and saying you have a PE. That's a lot of work also for them, you know, for little output. But what we see a lot, of course, is situations, especially also for small and mid-sized companies, where each employee can really create a lot of added value, yeah, for the company. And that is going to be really an issue. And then, of course, the CEOs, yeah, during the pandemic, we've seen many. They had a secondary home in France, and they say, okay, let's go to the secondary home to France. And then actually you realize they didn't go back. Yeah, the pandemic was over. Yeah, and they didn't go back. So, okay, now what happened? Residency changed, and then the issues we were addressing to this webinar occurred. Yeah?
Yeah. Thank you, Mike and Sofian, for your answer. Are there any other questions?
I have a question. What if you have entities in both countries, and you have someone who mainly works in one country, but occasionally, but irregularly works in the other country?
For the other entity, or for the initial entity?
No, for the initial entity. So there's no contract change. So he
Yeah,
keeps working for the entity where he is on the contract.
Yeah.
But he will occasionally go to the other entity. A little bit mixed, a bit social, but also doing actual work, taking decisions, signing contracts, because that's part of the job.
Yeah. But always still for the original entity.
Always for the original entity, and always irregular. So it could be multiple weeks a year, but never in a fixed pattern.
Yeah, I think that is important. Okay, that you're limited in time. Okay. But if it is true, the permanent establishment must be permanent. Okay, so you need a certain permanency. So what you do is, of course, you don't want to go him not every month, because if you say, for example, he goes there every month for 1 week, okay, even if it's only 1 week, it is something permanent. Yeah. Yeah, so there you must watch out for this type of situation. But if it's really occasionally, and you don't have a fixed calendar, fixed periodicity, you can still say, well, no, it's only when needed. Okay, I go there when there is a need. Okay, that I go there. So yes, what I would recommend is don't have a fixed periodicity. Yeah, don't tell a person go there every month. No, just say, okay, from time to time you can go there. That's how we would write it in the contract. From time to time.
Okay. Thank you.
And you mentioned before also that the travel calendar is very important. Is that something that you just keep in case it's questioned, or is it something that you have to present when you do your tax declaration?
Yeah, you need to have the tax calendar complete for the preparation of your tax return as a tax resident. Yeah. Because as I stipulate, you need to disclose your worldwide income. So in the case, the French source income and the Dutch source income. And by the application of the tax treaty signed between France and the Netherlands, we will apply a tax credit for the part which is taxed in the Netherlands. Okay. And so the travel calendar is necessary in order to prepare on a monthly basis the loan-effing calculation or the withholding tax calculation in France. On a yearly basis, in order to be coherent between the two countries, what is taxed in the Netherlands as a non-resident taxpayer should not be taxed by France, but disclosed to France, and we apply the tax credit. And in case of tax audit, both by the Netherlands or by France, you need, in addition, to keep all the business character of the business trip and the purpose. So if you travel for business, the professional expenses refunded by the company should be kept as supporting document, not in the file, and you need to constitute the year you business travel, but keep, because the tax audit will come, not the year of the income, but 2 or 3 years after. So, and people within the organization change. So the best is when you file your business expense, you scan and you file in record on your computer.
Yeah.
Thank you.
Yeah, and the calendar is also important. Sometimes if you don't know where the employee is a tax resident of, yeah, I mean, it is not something you necessarily ask your employee when you are hiring. Where are your tax resident? It's a very personal question, okay, because it depends on family and children, etc., etc. So as an employer, it's sometimes not easy to ask this, and that's also why you want to go to an advisor. Maybe the advisor has a discussion with the employee and to identify this, because I mentioned it in the introduction, the residence is really key to this. And sometimes you really don't know. I recall situations during the COVID period where they said, I don't know where my employee is. Yeah.
And also, Mike, travel calendar is also necessary for all the sourcing for equity.
Oh yes.
So
yes,
that's it's a professional document and a tax document. All global mobility situations should have.
Yes, and if you have to be prepared for audits, and even if you have to go to court, you don't only need the calendar, but you also need the supporting documents. You need the vouchers. You need everything. You need the bank statements. So yeah, it's not easy, but it's very important to keep track of this. That's why nowadays we have softwares to keep track of this.
Well, sometimes with recruitment, you even see the question like, do you want to be a freelancer or do you want to be on a payroll? And then basically the question is, who's going to take care of the admin?
Yes. Yeah. Freelance is also. We have a couple of minutes more. Freelancer is also an interesting thing because is the freelancer really a freelancer? Yeah, that's also something to be very careful to. If he's only working for one employer, can we really say it's a freelancer? That's a big issue, and the consequences are also not easy to assess.
And in France, the audit for the freelancer is more social audit.
Yes.
Because as you know, the social security contribution is very high because the coverage is very expanded compared to the Netherlands. And people fear about to receive a question from the URSSAF, so the social security authorities, instead of receiving question from the tax authorities. So it's the link of subordination is key. So if the freelancer work exclusively for one company, you need to draw attention.
Okay.
Are there any
Thank
more
you.
questions? No, we got a thank you from Jeroen. And if there are no more questions, I'm going to do the same. I'm going to thank, of course, the audience for being there with us, but mostly I'm going to thank the Mazars professionals for being with us today, for sharing your knowledge, sharing all your expertise. And for anyone who still has a question or thinks now after hearing this that he needs to maybe screen his company on this quite complex, let's say, topic, you can always, of course, contact one of the Mazars professionals to do so for your company. So thank you very much. Thank you very much, Sylvie, Mike, Elodie, and Sofiane for being with us today and sharing the information. And of course, we will put both the presentation and the recordings on our website if you need to ask, so to check some more information about it. So thank you very much, and I wish you a lovely afternoon.
Thank you.
You're welcome.
Thank you.
Our pleasure. Thank you very much.
Bye.
Bye.
Nice day.